The Tax Cuts and Jobs Act was passed in 2017 with a built-in expiration. Most of its individual provisions sunset at the end of 2025. For self-employed people, this is not a distant legislative issue. It is a direct threat to deductions you've been claiming for 8 years. The 20% QBI deduction, the higher standard deduction, the expanded child tax credit, the estate tax exemption at twice its pre-TCJA level. Without congressional action, all of these revert to their pre-2017 status on January 1, 2026. How much of this gets extended, modified, or allowed to expire will determine your tax bill for the next decade. The Qualified Business Income Deduction, IRC, Section 99A, allows eligible self-employed people to deduct up to 20% of net qualified business income. On a $150,000 net profit, that's a $30,000 deduction, worth $6,600 to $11,100 depending on your marginal rate. This deduction was created by the TCJA and sunsets after 2025 unless extended. If it expires, a self-employed consultant netting $150,000 faces an effective tax increase of $6,600 to $11,100 per year, with no other changes to their income or behavior. The QBI deduction is one of the largest single tax provisions benefiting the self-employed, and it is scheduled to disappear. The standard deduction for 2025 is $15,000 for single filers and $30,000 for married filing jointly, with inflation adjustments built in from the TCJA baseline. If the TCJA expires without extension, the standard deduction reverts to approximately $7,550 for single filers and $15,100 for married filers in 2026. For the roughly 87% of taxpayers who use the standard deduction, this is a direct income tax increase. Self-employed people who itemize claiming home office, mortgage interest, and state and local taxes are affected differently, but the SALT deduction cap at $10,000 also sunsets in 2026, which could benefit high-tax state residents who itemize. Bonus depreciation, which allows immediate expensing of qualifying property purchases, has been phasing down under the TCJA schedule. In 2023, it was 80%. In 2024, 60%. In 2025, 40%. In 2026, 20%. In 2027, it reaches zero unless Congress acts. Section 107(9), which allows immediate expensing up to $1,160,000 in 2023, with adjustments for 2025, remains in effect independently of bonus depreciation but has its own limitations. A self-employed person planning equipment purchases should note the window for 100% immediate bonus depreciation is closed. At 40% in 2025, the remaining depreciable basis must be depreciated over the asset's standard useful life. The estate tax exemption doubled under the TCJA from approximately $5.5 million to $13.61 million per person in 2024. For married couples, the portable exemption approaches $27 million. At the TCJA sunset in 2026, the exemption reverts to approximately $7 million per person, roughly half the current level. For a small business owner with a business valued at $8 to $12 million, the difference between the current exemption and the post-sunset exemption could create a seven-figure estate tax liability that did not exist under current law. Estate planning decisions made today, GRATs, IDGTs, family limited partnerships, must account for the possibility that the lower exemption returns. The 1,099K reporting threshold changes have been repeatedly delayed but are progressing toward a lower threshold. Under the American Rescue Plan, the threshold for third-party payment processors, PayPal, Venmo, Stripe, Square, to issue a 1,099K was reduced from $20,000 and 200 transactions to $600 with no transaction minimum. After multiple delays, the IRS implemented a $5,000 threshold for 2024, with a $2,500 threshold phasing in for 2025, and the $600 statutory threshold potentially applying in 2026. This affects self-employed people paid through any third-party platform. The income was always taxable. The 1,099K just makes non-reporting harder to miss. The strategic response to TCJA uncertainty is to accelerate beneficial transactions into 2025 wherever practical. If you're considering a business sale with a large capital gain, completing before 2026 avoids any potential capital gains rate increases. If your estate is approaching the exemption threshold, gifting strategies and irrevocable trust structures executed before 2026 lock in the higher exemption for lifetime gift tax purposes. If you've been planning a major equipment purchase, buying in 2025 at 40% bonus depreciation is better than waiting until 2026 at 20%. Tax planning in a legislative transition period is time-sensitive in ways that ordinary tax planning is not. Retirement account contribution limits for 2025 increased with inflation adjustments. Solo 401k employee deferral, $23,500 with a $7,500 catch-up for those 50 and older. Total solo 401k limit, including employer contribution, $70,000. SEPIRI, $70,000 or 25% of net self-employment income, whichever is less. Simple IRI for small employers, $16,500 with $3,500 catch-up. These limits represent the maximum tax-deferred savings available and are the single most powerful tax reduction tool available to self-employed individuals regardless of what happens with TCJA. Maximize them every year. The limits are adjusted annually. Check IRS, publication 560 for the current year figures. The Corporate Alternative Minimum Tax, CAMT, introduced by the Inflation Reduction Act, applies to corporations with 3-year average adjusted financial statement income above $1 billion. This does not affect the vast majority of small businesses. The 1% excise tax on stock buybacks also applies only to publicly traded corporations. The R&D deduction changes under the TCJA, which required domestic research expenses to be amortized over 5 years rather than immediately deducted, continue to apply in 2025. If your business conducts qualifying research activities, the R&D credit under IRC Section 41 remains available and can offset payroll tax for qualifying small businesses. The 2025 tax environment is a transition period, and transitions create both risk and opportunity. The QBI deduction may disappear, the standard deduction may drop. The estate exemption is likely to be cut. Bonus depreciation continues its decline. The response is not to wait for congressional certainty. It is to act on what you know now. Maximize your retirement contributions, consider timing-sensitive transactions before the year ends, and work with a CPI who is tracking legislative developments. for the foundational self-employment tax strategy that applies regardless of what Washington decides. The SE tax deduction video covers how to reduce your self-employment tax burden with every tool currently available.